There we go. You need to start with the income statement. Why is that? Based upon what I said on Monday. What do you need to calculate on the income statement? Net income, because net income is a component for the statement of retained earnings. And ending retained earnings is a line under the stockholders' equity section of the balance sheet. So you have to do them in order. You have to calculate net income for the period in order to be able to calculate ending retained earnings, and you have to have ending retained earnings in order to do the balance sheet. So you always start. There is a 3-line header at the top of every financial statement. You'll find that accountants are very organized. So, did everybody get a sticker that wanted a sticker? So, all right. Yes. Oh, can you pass that back? It's just the sticker for the tutoring center. So, it's the phone number, email, and all that. All right. So, in this case, it's going to be landscape design. The second line of the 3-line header is the financial statement. In this case, it's the income statement. And then the third line is the date. Now, both the income statement and the statement of retained earnings, as I mentioned on Monday, measures activity. So it is for the year ended in this case November 30, 2011. All right? And you've got to do that because you have to let the readers of the financial statement know what it is they're looking at. So in this case, it's the income statement, and it is for landscape design. And so you'll see that on every annual report that you pick up, or every report that if you downloaded any information off of a publicly traded company's website. It will always have that same exact header for every company out there. We'll begin with revenues. And they have what is known as design service revenue. And it says here in the first column of that alphabetical listing of account balances that they made during the year that ended on November 30, 2011, $248,000 in design service revenue. And that's the only revenue that is listed in this particular simplified example. At that point, we need to identify the expenses. So expenses are pretty easy to identify because in this list, they actually have the word expense after them. So if you go down through here, the first one that comes up is income tax expense. I'm going to hold off on that because I'm going to leave that to the end. But then at the very top of the next column, we have marketing expense. So this would be for advertising and they spent $19,700 marketing their services. The very next line says office rent expense. And that is 18,200. Continuing down that little alphabetical list, we come upon salaries expense. That's a big one, $96,000. And then the very last line in that listing of accounts says utilities expense. And utilities totaled $3,100. That's it. If we add all that up, we'll get total expenses of $137,000. If we subtract that from the total revenues that we had, we'll get income before income taxes. And that's $111,000. And that's why I saved that income tax expense to the very end. God bless you. From that, we'll subtract income tax expense. Of $38,850, and that will give us net income of $72,150. So for the year ending November 30th, 2011, the Landscape Design, Inc., Incorporated, made $72,150 of net income on total sales of $248,000. Not bad. Anytime that number's positive, it's not bad. Right? Now, the second thing you'll notice is I put a double underline underneath the net income number. That tells the readers of the financial statement that the financial statement is ended. It doesn't continue on the next page. That's the last line that we're presenting. All right? So the next one that we're going to do, we do the same three-line header, landscape design. Is the statement of retained earnings. And this also measures activity for the year ended November 30th. Nope, this is the same problem. It's a continuation of the same problem. The problem is asking us to do the three financial statements that we're focusing on during the first half of this course. Okay? So of the three, this one is without question the easiest one. We start with retained earnings November 30, 2010, last year's. And that's what is listed in the textbook, and it states it. On that second column there on the far right, it says retained earnings November 30, 2010. So this is beginning retained earnings, and that's $55,400. All right? So for this statement, we're going to start with what retained earnings were left in the business, not distributed out to the shareholders, as of the end of last year. And we're going to add net income for the year. Which we just got finished calculating at $72,150. I'm going to add those two together and get a subtotal of $127,550. In this first column, under the alphabetical listing, it stated that we had dividends. Dividends are a return of profits to the owners. All right? If you go out and buy a share of stock in a publicly traded company, more than likely, they are going to send you dividend income throughout the year. Boeing sends it to me 4 times a year. So normally after they release quarterly, they declare and send me a dividend. Just a couple of dollars per share, but it's not bad, something. So from that, we're going to subtract dividends. In this case, it was $40,000. And that leaves us $87,550 as retained earnings for November 30, 2011. Yes, sir.
What does it say before dividends?
Less. I apologize up front. Do not hesitate to ask me to clarify my handwriting.
So you add the retained earnings and the net income?
Yes, we add those first two and got a subtotal of $127,550, and then we subtracted dividends. That's pretty close. Come on. Maybe the E needs to be.
So when you subtract that but less?
It's awful. I admit it. Then I subtract it, yes, and then that gives us the $87,550, which is the ending balance of retained earnings.
On that example though, when you subtracted, you didn't put less.
I did not, because expenses are implied to be negative, where here it's not. Yes, sir.
So like for a homework problem, this is how it needs to be.
Right, and exams, equally. Yeah, this is the format that you'll be doing on the first midterm.
Do we need to remember all the words that were going in, like the less dividends, the subtotals, all that stuff, right?
You need to know, yeah. Yeah, and you need to know how that revenues are first, and then the expenses are next, and then income before income taxes. Yeah, that's what we're testing you on. Yes, sir.
Let's say you're the owner of a business.
Uh-huh.
On the expenses, do you put your salary in the salary expense, or are you part of the dividend?
It depends on how you've organized the business. Because most small businesses that are wholly owned, like if I own my own company, I would do dividends because that's just a return to me of, well, now we're getting into income taxes. It's a distribution because most closely held corporations are taxed at the individual rate. And that's one of the problems that we have with our taxation system is it's double taxed. So the corporations, if you don't do what is known as a subchapter S, subchapter C corporations pay taxes on their income. And then individual shareholders pay taxes on dividends. So the same money, the same revenue was taxed twice. And so there's a way around that if you've got a closely held corporation. And that is you do the dividend rather than salaries. Okay? Does that make sense to everyone? So the answer is it varies. Okay? All right, that's the two. So has everybody got this one? I'm going to erase it and then start the balance sheet. That's the last of the three statements.
Could you repeat what the definition of dividend is?
Dividends are a return of profits to the shareholders.
And this one is not gonna say for year ending?
No, and I was just getting ready to say that. This is the one exception to those other two statements, and actually even when we get to cash flow. The balance sheet does not measure activity. It can't. It is simply a snapshot, a picture in time at the stroke of midnight on November 30th. And for that reason, the three-line header does not say for the year ended. It just says the date. Sometimes you'll see them and it'll say as of. But just the date is acceptable.
So basically this statement is made on that day. Say-
Correct, because the cash balance changes second by second with a large corporation. So you can't measure the activity in the cash balance. You can only measure what was it at the stroke of midnight. So, yes, sir.
Why in the statement of retained earnings is it 2000? Which one had 2010?
2010 was the beginning balance of retained earnings. And then we added this year's net income and subtracted the dividends that we sent to the shareholders to get the ending balance. Yeah. And that was the one exception on this list in the book, is that all of the accounts in here were as of November 30th, 2011, things like the accounts payable, accounts receivable, and stuff like that, with the exception of retained earnings, and it stated it that was 2010s, because you're calculating it. Okay? Any other questions? All right, the balance sheet is a representation of the accounting equation. Assets equals liabilities plus stockholders' equity. So we'll begin with assets. Assets are everything a company owns in order to conduct their business. All right? So, in this listing, the third line down says cash. Cash is something a company owns in order to conduct their business. And they had $115,750 worth of cash. At the stroke of midnight on November 30th, 2011. The next item in here is accounts receivable. Now, accounts receivables are bills, invoices that you have sent to your customers for services rendered that they haven't paid you yet. It's money owed to you. Okay? Accounts receivable amounted to $9,100. And then the last asset that they had on this relatively simplified example is they had some supplies. Could be paper, toner for the copy machine, pens, paper, pencils, stuff like that. And they had $800 worth. And that's total assets. $125,650. And in the book, for those of you that have a book, the problem actually tells you off to the side that total assets are $125,650. It gives you a little check figure to help you solve the problem. So you know that you got this right if it matches what the textbook says. All right, I'll do the other half of it over here. And that starts with liabilities. So liabilities are everything that they owe to outside parties. All right? This starts with accounts payable. Accounts payable is the opposite of accounts receivable. Accounts receivable was us sending invoices to our customers. Accounts payable is our vendors sending us invoices that we haven't paid yet. So we owe $7,400 to our suppliers and contractors that may do work for us and the utility company maybe, things like that. Then we have income taxes payable. We owe the government $13,000 even. And then lastly, we have some salaries payable. We owe employees that we haven't yet paid $2,700. And that gives us total liabilities. This is not a very good pen. Oops. So if you add up those three numbers, we'll get 23,100. Oh, much better pen. And then the last of the accounting equation is stockholders' equity. Stockholders' equity includes common stock, this is what the owners put into the business in exchange for the shares of stock that indicate their ownership percentages. And they put in $15,000. And then the other aspect of stockholders' equity is the profits that they have left in the business, did not distribute in the form of dividends back to themselves. So that's retained earnings. And we just got finished calculating that at $87,550. Add those two numbers together, we get total stockholders' equity. Of $102,550. Add that to the total liabilities, and we get $125,650 as total liabilities and stockholders' equity. Which is the amount that we calculated for total assets. Hence the balance sheet aspect of it. Yes, sir.
So what'd you say, what was accounts payable again?
Accounts payable is amounts that you owe vendors, suppliers, people who send you inventory, your lawyer, your accountant, whoever sends you an invoice that you have not yet paid yet. You all have that, right? You got a credit card bill, you got a cell phone bill, or maybe your mom and dad did. That's accounts payable.
Like people that you pay that are asking for the money?
Right. They've sent you an invoice, but you've not yet cut a check.
And same thing with income taxes?
Income taxes is what you've calculated you owe the government, but you haven't sent the government. Same with salaries.
Employees?
Employees have earned the money as of November 30, but maybe you pay every other Friday, and November 30 hit on a Wednesday. So you owe them that money, but you haven't paid them yet.
So I know retained earnings is what the owners keep in the business.
Is what they've left in the business, correct?
What is common stock?
Common stock is when you created the business or you brought in a new shareholder, you issued common stock in exchange for an influx of cash. So when a company goes and does an initial public offering, that always makes news, like when Facebook went public, that's common stock. They issue common stock in exchange for cash. There was another question over here. Yes, sir.
Where did you get that 125,600?
I added the 23,100 to the 102,550. I added total liabilities and total stockholders' equity.
In a profitable business, where George assets to be higher than the liability?
Yes. It doesn't always happen that way, but yes, you always want to have more than you owe. No different than you guys, right? It's no different.
But this shows that this landscaping company, they don't owe anything, right? At the end of the year, since it balanced out.
No, they do owe. They owe $23,100 to external people.
But since that equaled the assets, do they lose anything?
No.
They're just right as
No, it just means that of the total assets, they owe about a fifth of it. 20% they owe to other people. Pretty healthy. You won't find that in most publicly traded. Well, Apple will have that kind of, because they don't owe anybody. They've got way too much cash. Microsoft, same thing. But if you go look at Boeing, 20% is not quite. They owe a lot more than what they own. So, yes, sir.
So the assets are supposed to equal the liabilities and the stock. Right?
It does, and it does by definition. All right, and think about it. Even you as individual students, your assets equal your liabilities plus stockholders' equity because there's only one of two ways to buy something, right? Your money or credit, right? That's it. It's the same with them. It's the exact OPM or yours. So make a choice. Everybody understand that? Got it? Okay, let's do another one. Little bit more complex, not significantly so, but we'll do problem number 7 on page 40.
three-part thing?
What's that?
We're doing a three-part?
Yeah, we're going to do all three statements. Yep.
You said on page 30 something?
40.
40?
Page 40, problem number 7. And I always write up the problem we're working on and the page that it's found up here in that top left-hand corner. All right, on this one, the accounts of Real Deal Inc. follow. The company just completed its 10th year of operation. Now, why would it be important for them to tell us that it is completing their first year of operation versus their 10th year? Anybody think of why?
Because it means that they've done a decent enough job to stay 10 years.
Yes, and they did that by accumulating some retained earnings. So they've met one of their two overarching goals. Because remember, all for-profit businesses have to do two things in order to survive. They have to be profitable, and they have to be liquid. Exactly. You have to generate enough cash to pay your bills when they become due, especially payroll. You gotta make payroll, okay? Because when you don't, that's the beginning of the end. So once again, it's an alphabetical listing, and true to form, on the second column it says retained earnings as of December 31st, 2010. So that's the one exception to the listing that they've given us. 3-line header, Real Deal. The income statement is first. Measures activity. And in this case, it's December 31st, 2011. Revenues. So when you're looking down that little alphabetical listing, you'll only find one account that is listed that ends in revenue. And in this case, it's commission sales. So they're selling something on a commission, who knows what. And they sold a healthy $400,000 worth on commission. So they could be a manufacturer's rep, you know, where you're going out and you're selling Bic pens or Elmer's glue or something to stores, and you get a commission on it. So that's where that's coming from. Then we need to subtract from the total revenues the expenses. So looking down, it looks like we not only earn commissions, but we pay commissions to our sales staff. Because the 5th line down in that left column is commission expense. And it totaled $225,000. Yes, sir.
Will it always say expense next to the value?
It will in most cases. In a latter chapter, there's a little odd account that doesn't say expense after it. But for right now, in the first midterm, it'll say revenue or expense. Yeah, it's just, yeah. It seems awfully redundant. And on a midterm, because you're under a time constraint with a midterm, if you just want to write commission, I'll accept that. But in reality, if you look at financial statements that are published, they'll all say expense. Yeah. All right, then it has that income tax expense that we'll save. And then in the left column, in the right column, they have marketing expense. $20,100. It has office rent expense, just like the last company we did. $36,000. Telephone and computer expenses. And I'll just abbreviate that because it's so long. 5,100. Utilities. $2,600. And then lastly, wages. $32,000. Add all that up and you get $320,800 as total expenses. Subtract that from the total revenue that we generated, and we get $79,200 for income before taxes. Actually, income before income taxes, just to be redundant. And that'll give us net income. I'm sorry. Income tax expense. Then give us net income. So income tax expense was $27,000. Leaving us $52,200 as net income. Double underline. All right?
How do you get that income?
What's that?
How do you get the, or like income taxes?
It's given to us in the problem right now. Later, we'll calculate them, and it'll give us a rate, and you would take this income before income taxes, and the problem will tell you that income taxes are 30%, and then you multiply it out. But for right now, it always gives it to you. And on the first midterm, I'll give it to you. Yes, sir.
Is income tax like the same as a regular tax?
No, it's the same as you guys pay for the wages. The corporations pay it, yeah, at a tax rate. There's no different. Their tax rate is different than ours as individuals, but it's the same.
Is their tax rate not graduated?
It's graduated, yeah. They have a multi-step. It's not as complex as ours. Ours, I think, has 5 or 6 steps in it, and theirs, I think, has 2. I don't teach tax anymore, so I don't remember. So I'd have to go look it up. Okay? Everybody good so far? All right. Real Deal Inc. Statement of Retained Earnings.
So this is still pretty much like one big problem.
Yep. Just like we did on the first one. Yep. This measures activity, so it is for the year ended December. So the one exception on that listing in the textbook was the retained earnings balance was as of last year, which we started the year, with $35,300 in retained earnings. To that, we're going to add net income. For the year, and we just calculated that at $52,200. That'll give us a subtotal of $87,500. What are we going to do next? We're going to subtract. And I'll write it clear this time. There you go. How about that? You read that one? Less dividends. And the problem gives us $33,000 in dividends. And that leaves us $54,500 as retained earnings for December 31st, 2011.
So do you want that always higher than the year before?
Yeah, because that means you made money and you didn't distribute it all. It doesn't always happen that way because, of course, people do lose money sometimes, and sometimes they distribute more than the current earnings for reasons that they need. Yes, sir.
Each form is important, like
Yeah, and I'll get into that in the review. I'm going to give you a piece of paper. For purposes of doing these financial statements, and actually, I give you, I don't have one with me. I give you a 4-column long piece of paper to do for the exams. And it's ledger paper, and I'll show it to you and how to use it and stuff like that. It's the way when I started, that's the way everything was done before the advent of computers. Yeah, it was all ledger paper. Anyway, so, yes, question?
When you guys do your accounting, do you just keep like the ledger balance, you open it every time somebody makes a move, or do you just get the receipts and do it all at one time?
It depends on the size. A lot of small mom and pop type things, they'll do the accounting probably maybe once a week at best, once a month at worst, once a year in order to do their tax returns at really, really worst. So it depends. Major corporations or even mid-sized corporations, like I used to be the chief financial officer for, every day we would process the stuff that comes in the door. Yeah, to keep it up to date. Because otherwise it just gets overwhelming when you're dealing with thousands and thousands of transactions. Yep. So it depends. Okay. The last one is the balance sheet. Does not measure activity, so it is not for the year ended. I will emphasize that over and over and over again between now and the first midterm. Because if you put for the year ended, you're going to lose points. Because it cannot measure activity. It's impossible. So, assets. Begins with cash. And this particular company had $57,700 in cash. They also had some accounts receivable. Totaling $4,500. Some supplies, just like the last company did. $700. But they also had what will eventually be called property, plant, and equipment, a long-term fixed asset. In this one, they have some equipment. Which cost them $59,900. Add all that up, you get total assets of $122,800. Yes, sir.
Does your assets have anything to do with your net income?
No, net income is an indication of your profitability, and that goes into stockholders' equity in the form of retained earnings. Yeah. Now, having said that, during the process of earning net income, you will generate assets because you'll start receiving cash, and you'll have accounts receivable from your customers that owe you money. So they are related in that fashion. Other questions so far? Liabilities. Yeah, tax rates are set by Congress. Yeah, so you know way in advance what the tax rate's going to be. Yep.
Should they always be side to side, liabilities and assets?
What's that?
Should assets and liabilities always be side to side?
Yeah, in your midterm though, you're going to do them first, assets first, and you're going to put liabilities and stockholders' equity down below because you won't have a wide board like this. You'll have a piece of paper. So, yeah. But assets are always listed first. So whether it's side to side or up and down, it's always first. All right? So, liabilities. They have accounts payable. Of 3,600. They have income taxes payable. $13,000. And they have commissions. Payable. $22,700. Add all that together and we get total liabilities of $39,300. And the last section is stockholders' equity. We have the common stock. Totaling $29,000 and retained earnings that we just got finished calculating at $54,500. Add those two numbers together, $83,500 is total stockholders' equity.
We'll just abbreviate it to ASCII.
Yeah. Yeah. Add the total stockholders' equity of $83,500 to the total liabilities of $39,300, and magically, once again, God bless you. And a lot of sneezing. People are allergic to accounting. You get the same total that we had for assets, $122,800, and that's total liabilities and stockholders' equity. Okay, we have 10 minutes left. I'm going to go ahead and project it, and you can get started on it and then finish it up between now and next Monday. And next Monday, I'll start the class by projecting the solution. Yes, sir.
I think we have class on that.
We do not. Next Wednesday, 1 week from today. Thank you. I would not have forgotten that. Yes.
I just don't understand why assets or everything that